Welcome from Kirk Spano to my Fundamental Trends broadcast. Also working in conjunction with Mark and Watch and Seeking Alpha and a few other publications, but mainly Seeking Alpha. Wanted to do a presentation this week that would help us understand where we are in the markets right now. I know there's a lot of angst about the volatility that happened recently. But there's also an awful lot of bulls still thumping their hooves and pounding their chests. And I like to just show about where we are and what some of the mounting pressures are so that we can take advantage of ways to protect ourselves, but also to find opportunities to make some money. So I'm going to start with an article that I wrote recently that actually wasn't very well read, surprisingly, from all the comments. The people who commented just like to comment a lot. Welcome to President Trump's economy and markets. I identified four things that we should expect to manifest over the next couple of years. And I talked about what was coming way back in my letter to clients in January of 2017, Challenges and Opportunities for the Trump Presidency. And I did talk about, one, I did predict that Trump would win, and how I predicted it. It was based on the masks. I wear a Halloween mask the year of presidential elections, and I've gotten the next president right every time. So this year I wore a Trump mask, and sure enough, he won. And I describe why I think he won. I drive around the country a lot. So I get to talk to an awful lot of people. And it was basically the people in flyover country feel like the East Coast passed them by, and this was revenge. This is, hey, we want to see what this guy can do because your folks keep passing us over. And ultimately, I think that was the swing vote. I mean, sure, there's a lot of talk about racism and things like that. And I have no doubt that there was some catering to that nationalist side and to the racists, but they're a small percentage. So it really was a lot of middle-class people, and if you've seen some of the Van Jones interviews, middle-class people who felt left behind and were upset, and they're like, well, let's see what this guy can do and make a point of saying, hey, if you pass us over, this is what happens. Now, hopefully, President Trump is great. I think he's got a chance to be a great president. I don't know if it'll happen. And as a guy who voted for President Obama twice, I will say I didn't think President Obama was a great president. I thought he was slightly above average, but in the years that he had the Congress to do anything he wanted, clearly there were some things that he did that didn't work out. For example, the healthcare bill was a step in the right direction, and it's slowly gotten blown up. And it really wasn't what we needed. And ultimately, he missed several opportunities. You guys know that I think he should have supported the Iranian uprising, but he didn't. And I think that those are two things that we're dealing with now is in the future healthcare. I think the Iran issue is going to be resolved imminently, or not resolved, but confronted imminently. And that has been one of my themes for the last year. So in any case, some of the threats and opportunities under President Trump, we have to overcome nationalism. Ultimately, globalism is good. However, we have spread out, or I should say we have not spread out the wealth very well. We have allowed it to flow literally to less than 1% of the people. The great majority of wealth, about 70% of the wealth, flows to a little less than 0.5% of the people. And that ultimately just creates these enormous disparities in standard of living that, leads to a lot of angst. So we do have to deal with that. Slow growth forever is a theme that I've put out there for years, and I talk about it later in the presentation, not much later, shortly later. And I think that it's something that people have to recognize, and I will explain a little bit more about that. And the new National Economics Advisor, Larry Kudlow, he doesn't believe in slow growth forever, and he's wrong, and that's dangerous. And then mounting debts, Iran and terrorism. So some things that I talked about. So if you'd like that link, I'm going to put that link up here to my website, my firm website. You can read about that. I think it was a pretty good analysis. So going back to what President Trump has to deal with and what he's going to impact. So he inherited a pretty good economy, but not a great economy. But maybe it was as good as we could expect in context of slow growth forever, which again, I'll get to in just a second. The world is actually getting better, and I know that people don't always believe this. I presume you can see what I'm putting on the screen. World population living in extreme poverty has come down and basically fell off a cliff after World War II. So not only is the world becoming a little bit better off, there's actually fewer people being killed in wars. Global crime is actually down. There's a lot of things getting better. However, with the internet, boy, oh boy, in the 24-hour news cycle, we really like to focus on all the bad things. So here are the 4 things that you're going to see with the Trump administration that they'll be dealing with. Deregulation, and I would be very cautious about deregulating in a way that copies the sort of deregulation that occurred in the early 2000s, because we know that it largely helped cause the financial crisis. So we have to be careful with the regulatory framework. Granted, we don't want to overregulate, but on the same note, we don't want to allow cheating and fraud and abuse. Global trade actions. There's been a lot of talk about a potential trade war with the tariffs that have been coming up. And I talk about free trade versus protectionism and why history matters. And this is an article I put up about that topic. And ultimately, protectionism, when it's broad-based, has never worked. Never, never, ever. So people need to understand that unless you have a very targeted type of tariff or protectionism because you believe that there's a bad actor, it's never worked. So I get the concept of wanting to protect American jobs. I understand it. You know, I grew up in a middle-class neighborhood, blue-collar largely. I understand. But there's a difference between having a feeling about what you want to have happen than having a pragmatic way of getting there. And that is really something that has to be thought well through. Hopefully, as I talk about here, the tariffs are negotiating points to get other things done. It seems like that's largely the way he leans or the way he hints, the president hints. However, you know, I think his nationalist roots are pretty strong. So the idea of being a nationalist is not an honorable thing. And you need to look up what that really means, because being a nationalist doesn't mean, oh, I love America. No, being a nationalist means that I basically don't like anybody else. And there's a difference. And we have to be very careful about how we take care of ourselves in the context of a global economy and the geopolitical realities that are out there. We can want lots of things, but the reality is that so do other people, and we have to take that into consideration. So I did mention here that he would need to back off on the tariffs with Canada and Mexico. Said that right here. I said he's going to have to back off of that extremely quickly, and they did. So that's good that they did that. I also talked about the interaction of the solar tariffs. Energy and steel and aluminum are big deals in the economy, and that's why these tariffs are particularly important. The tax cuts might not stimulate for long. We have to be very careful with the tax code. Right now, what they're doing is going to drive up a massive deficit the next couple of years, way more than the deficit ever was under President Obama. So keep that in mind. For all the people who complained about a couple of $1 trillion deficits after a financial crisis, we're going to have $1 to $1.5 trillion deficits the next couple of years, and things are supposedly good. Does it make sense to press on the deficit accelerator when the economy is purportedly pretty good? And I would say it's pretty good. But I think taking on debt to grow at this point is probably a really bad idea. And finally, the guy who will really control the monetary levers, Chairman Powell. I don't have a lot of confidence in this guy. He's not an economist. He doesn't really understand the levers. From everything I've read in his statements, I think Neil Kashkari would have been a much better choice out of Minnesota. He's a moderate Republican, and I think he understands, if you've read his essays, he understands the slow growth forever reality that's brought about by demographics and global debt and some of the deflationary pressures of technology. So those are the four things that we have to keep an eye on. Here's what Gary Cohen said or saw when he left over the tariffs. Inflation plus slow growth can equal stagflation. And I really don't want this to happen, but I think that we've increased the odds of seeing stagflation in the next few years, basically no growth but with inflation, markedly. So we are walking a tightrope right now. What is negotiated and done over the next 2 or 3 years is going to have a monumental impact on the way the 2020s look. And I really hope we don't start the 2020s with a stagflationary event. But I'd say that we are basically at a coin flip right now, up from it almost being impossible to have expected this 5 years ago. So with tariffs, with the change in monetary direction, which started under President Obama and Janet Yellen, I wholeheartedly disagree with unwinding the Fed balance sheet. I think they should let the Fed balance sheet run off over about 30 to 50 years so that it coincides with the flattening out of the population curve. People can talk about, oh my God, there's $4 trillion in debt. You know what? It's a 17, 18, 19 trillion dollar economy. Big deal. If you got a $19 trillion house with a $4 trillion mortgage, would you cry about it? No. And that's really what the Fed has. So when you take a look at the rest of the federal budget, and you say, okay, there's another $20 trillion of debt, and then you've got $4 trillion with the Fed. Which one is a bigger problem? It's not the Fed balance sheet, it's the federal deficit, the federal debt. So that's really what we should be focused on, not the Federal Reserve. Federal Reserve is doing just fine. So we have these offsetting factors. Inflation is always and everywhere a factor of the monetary supply, is what Milton Friedman and his partner said. However, as we saw in the video, if anybody watched it earlier, really we need to take a look at what's inflationary in the asset markets, because that can drive inflation in our everyday spending lives. So if we suddenly see the price of fertilizer, the price of metals, the price of food, the price of energy go up, not so much because of monetary conditions, but because of the capital that goes into developing those things, then we can get price pressure that not only filters in the asset markets and creates rotations, but it makes our lives more expensive. Right now, our lives are not that much more expensive than they were 5 years ago. Certainly more expensive, but it wasn't a shocking event. It wasn't something that, made people short on cash because, the price of milk went up, 30 cents. So Larry Kudlow, going back to the tax idea, said something yesterday. He said in his interview with CNBC, I don't believe in secular stagnation. He's stupid then. And I will say this very loud and clear. I know somebody who worked with Larry Kudlow pretty well, and he doesn't agree with his supply side economics or his view that the economy can just grow and grow and grow at these high paces. Why? It comes down to slow growth forever, which we're going to get into in a minute. But if they really cut taxes again, you need to understand that the trade-off is massive cuts in government services and probably in the military. I don't know how they not be able to do that, because the military is over half of government spending. So we need to think about what really is the right taxation level. And I would say that the major mistake in the tax code that they made was not eliminating a lot of the corporate tax loopholes. They didn't do that. They cut the corporate taxes, but they didn't get rid of loopholes, which is the 1-2 punch that they said they were going to do. They didn't get rid of the carried interest exemption, which is a joke. That allows guys like me to start a hedge fund and take my income and call it capital gains and pay half as much. And then third, they lowered the highest tax bracket, which kicks in at whatever it is, 4, 5, 6, 700,000. I'd have to double check, from 39.6% to 37%. My question is this: why did the biggest tax cuts go to that small 1% of the people? In dollar amounts, they got the biggest tax cuts. And I did cover that in one of the articles. In fact, I think I covered it here. So the tax breaks went really to the richest people. It doesn't make a bit of sense. These tax breaks at the bottom here should not have been there. And if we had just not done that, that would have sliced hundreds of billions of dollars off the deficit that we're going to see. And this money never trickles into the economy. If you've been paying attention for the last 40 years, it doesn't happen because people just add it to their pile. Yeah, sure, they go out and they buy, you can see my ads here on the side of the screen. They go out and buy a couple of nice things. And they invest a little money in the stock markets, but very rarely does it go into capital spending, which is what would actually make the economy grow. So I'd be very cautious about Larry Kudlow. He wrote a book. I'm trying to look at it on my bookshelf right now. American Prosperity, something along those lines. But he signed it for me. And if you read that book, go find that on Amazon somewhere. It's worth the $9 or whatever it'll cost you, or the e-reader. Read Larry Kudlow's book from 1999, and then you will see that he's been wrong about virtually everything forever, his entire career. So understanding and investing in a slow growth forever global economy. This is a foundationary piece over at my Blue Mountain Asset Management Investment Advisory. And I also have it up at Seeking Alpha in 2 pieces. But there are primers in articles that I wrote over the years. And we need to just understand this chart, right? This is a couple years old. But the percentage of younger people is decreasing and the percentage of older people is increasing. Older people don't spend as much money. Therefore, that is deflationary. Less money getting into the economy. And we are seeing the weighted global average age go up. Debt as a percentage is going way up. This is also a couple years outdated. I'm going to have to update all of this stuff. But global debts did not come down the last several years. They just kept going up. So if global debts are going up, and that is a foundationary piece of the expanding economy, then you either have to accept one of 2 things. Either debts can go up forever to support the economy, or debts can't go up forever to support the economy. Pick your poison. I believe that eventually the debts matter. And I think that ultimately we're going to see helicopter money to pay off a lot of these debts, and we're going to get a one-time inflationary event to offset the long-term deflation. I'll talk about that more in the future. So productivity is a problem. We haven't really seen a good productivity curve for a long, long time. So perceptions versus reality. We have to understand that there's political ambitions out there, and some of the things that they do to counter slow growth just really are damaging. They're counterproductive, and that's what I believe is going to happen here. I'm very afraid of what phase 2 of the tax cuts could be. Gonna do an aside to oil real quick because we're going to be getting into the dollar here in a second and the liquidity situation, which is very important. Oil prices Goldilocks moment. There's projections from Citibank, Goldman Sachs, myself, several others, that oil is headed to about $80 per barrel. And the International Energy Agency is saying, no, supply is going up so fast. Well, today, if you look at the very front page of Bloomberg, and it was on the front page a moment ago, the International Energy Agency stated that, oh, look, the demand for oil is going up a lot faster than we thought. I don't know where it is. I'm not going to look for it. But I've been saying this all along. The demand for oil is not going to really turn over for the better part of a decade or longer. And this idea that suddenly next year or the year after, we're going to see this massive move towards electric vehicles is just so ridiculously false. You can go out and buy a Nissan Sentra that gets 35 miles, 40 miles to the gallon for 17, 18 grand. Why would you pay $30,000 for an equivalent vehicle that's electric? Nobody's going to do it. So until those two prices converge, the bottom line is consumers just aren't going to spend more on an EV because it's an EV. Right now, Toyota is getting close with a hybrid. Their hybrid Camry is only $1,000 more than their regular Camry, and I think that that is a harbinger of things to come. I talked about on Market Watch about 5 years ago that I saw a much brighter future for hybrids than a lot of other people, and that's because you can take an electric vehicle and add a range extender with a couple of gallons of gasoline, and now all of a sudden you've got this car that gets between 50 and 100 miles to the gallon, and you only need, a 5-gallon tank that lasts for a month. So things like that are coming, and the technology for EVs with range extenders is getting very, very good. Something to also keep in mind, and this isn't for 5 or 10 years, but South America has the ability to increase their lithium production by about tenfold. It will take time to get there, but eventually lithium's not going to be that expensive. There's lots of it. They'll eventually get to it. And for buildings, you're not going to need lithium anyway. There's different types of batteries, flow batteries, and the things that Plug makes. I forget what they're called. But there's other types of batteries that are good for stationary environments, the size of a refrigerator, put in your garage and have a 3-day power supply. That's coming. That's coming in the 2020s. There's no doubt about it. The prototypes are out there. They're expensive right now. Production will bring those costs down, just like production brings down the cost of everything. So in the whole context of oil, yeah, demand for oil will turn over. It's not happening yet, and it's not happening really soon. And the supply for oil is being constrained very well by OPEC. And the idea that there won't be disruptions is just so silly that it amazes me that I get criticized for saying things a couple of years ago like Venezuela was in trouble or that Iran wasn't going to ramp up. I said 2 years ago Iran wasn't going to ramp up, and then sure enough, Iran really hasn't pumped much more oil, only about 750,000 barrels extra per day since the sanctions came off. Why? Well, they were about to start ramping up, but President Trump came in and said, hey, we really don't want anybody doing this. We're going to throw some other sanctions on Iran, which they did. And now they're about to do a lot more sanctions on Iran. So it's not hard to see that there's going to be pressure on oil supply no matter what. And we have to take into account that most of the American oil only comes from a couple of places: the Permian Basin, the Gulf of Mexico, a little bit from the Eagle Ford, others in the Bakken. So this is 5 other basins, and this is the Bakken. There is no increase in production. Why? Because they have high-graded, which means drilling the best stuff first, cheapest stuff first, to the point where it's more expensive to get oil out of the ground, and they're getting further and further away from the core of the play. That's started to happen in the Eagle Ford in the last couple of years. They're not quite there yet. They have a couple more years of expansion, but not very significant expansion. The Gulf of Mexico just had a boom. President Obama allowed that, and President Trump is pushing it. But again, the Gulf of Mexico, the easy plays are getting used up. And then the Permian is expanding, but the same thing's going to happen to the Permian. It looks like 2-3 years out, they happened everywhere else. They're going to high grade, they're going to the best locations, and then production will fall off because with shale wells, the production falls off dramatically within 2 or 3 years, down 80-90%. So you drill a well today, and what you get the first year to what you get the third year is an 80 or 90% difference. And if you want to get another surge of oil, you got to go and refrac it. So, and then you get another year or two of maybe a couple percent higher output. So we aren't going to see 15 million barrels a day out of the U.S. It's not going to happen. 11 or 12, that's what I've been saying all along. We're going to push 11 this year, maybe 12 in the next 2-3 years, and then it's going to turn over. Well, in the meantime, the demand for oil is still going up by more than that, and in the rest of the world, we're not seeing demand supply increases. Angola, the North Sea, Southeast Asia, all these other oil basins have been falling off production pretty dramatically. They're doing what they can technologically to keep it up, but it's an uphill battle. Brazil has a couple of neat finds, so you'll see a little bit of Brazil oil coming online. The Arctic's dead. Ask Exxon. Exxon just pulled out of the Arctic. So oil is going to find that peak oil plateau that I talked about. Supply is controlled well enough, and demand is high enough that you're not going to see another oil crash. The dollar surging could pull a couple dollars off of oil, but it's not going to be anything monumental. President Trump just signaled the end of the nuclear deal with Iran. He said in January this would be the last time that he extended it, and now he has fired Tillerson, brought in Pompeo. Pompeo is a huge Iran hawk. So, you've seen oil come down, oil stocks come down because the price of oil hasn't broken through to the next higher range. It will. So if you want to consider where the next disruption could come from, it could come from Iran, even if there's not a military conflict. Because once these sanctions go on, and I expect that they will in about May or June, the rest of the world, I got criticized on this article quite a bit. People don't understand that if the United States puts sanctions on Iran, it's not like the rest of the world cherry picks it. Yeah, we're going to do that. We're not going to do that. That's not how it works. Because we're so influential in the banking system and the SWIFT system, if we say, hey, if you're going to buy oil from Iran, we're going to cut you off from a SWIFT or from our $19 trillion currency and bond market, that's bad for somebody else's economy. They're not going to buy a few 100,000 barrels of oil from Iran and then face not being part of the global financial system. Okay, so these little ideological arguments that I get in the comment sections of these articles, it's just mind-boggling to me that they have no clue what they're talking about, and yet they run their keyboard. So it's important to know that if we put sanctions on, that will cause an increase in the price of oil, because that could bring off as much as the entire 750,000 barrels a day that Iran brought on. 750,000 barrels a day, that's a lot. But even if it's 250,000 barrels a day, what if China finds an in-between way, because they need the oil? There's a lot going on there, and don't dismiss the idea that the United States is posturing to sell oil to China. So, just keep all these things in mind. There's a lot of moving parts. I wrote this article this week. The buyback bubble will end badly. Again, I got criticized. And I'll tell you, the more I get criticized, the more that I think that I'm right, because when you're a contrarian, typically the more adamant the opposition to you, the more likely you'll be right. You just got to figure out when. And I think that the buyback bubble ends badly next year. So I said as soon as Q1 2019, but it could be sooner. The buybacks have been the only thing holding the stock market up. Forget about fundamentals. Fundamentals aren't that good. Everything's overvalued. Total shares outstanding in the stock market, this is from Yardeni Research, has been going down since 2010. What does that coincide with? All the QE, right? Government starts printing money, buybacks go up. Now the government stopped printing money, but we have this huge tax break. So we're going to see a record purchase of stock this year. So the stock buyback is going to go through this chart straight up. It's going to be way up here. Where my cursor is, it's off the chart. Almost 1 trillion shares of stock are going to be retired this year. Then it's going to plunge all the way back down to like in here. So the support for the market will last into the first quarter next year, maybe a little bit longer. But then the buyback support is gone because the repatriation is a one-time event, right? And the margins, because of the tax cuts, companies' margins really aren't going up much. I think I saw 1.7%. It's not monumental, and they're spending that money on everything else. So don't discount that the main factor in the stock market the last 9 years has been the quantitative easing. That money gets into the system through the primary dealers, primary bank dealers. That gets into the corporate infrastructure. Now we have a tax break that brought that money back. So you had a 1-2 punch of QE and then tax breaks for buybacks. The buybacks are not forever, and you have to be aware of that. It's monumentally important because everybody else is really a seller. So if you go through this article, and I will put that link up for you in case you don't have it, but I know that most of you do, you're going to have a tough time adjusting when the buybacks, when the corporations aren't buying stock, you're going to get a bad year. And I'll give you an example. Look, corporate buybacks, 2006, 7, 8, bam. This was the beginning of the crisis when buybacks fell and earnings fell and liquidity fell and everything went to heck. Now, I don't expect this. I think there's a new floor somewhere in the middle because we have printed so much money. All right, so here's a sign. Here's a canary in the coal mine for you. The LIBOR spread and it's widening. Why is that a big deal? So read this Bloomberg article, and they talk about how LIBOR, the London interbank offered rates, is going up. It's pulling the overnight index swap up, and other way. I mean, so you're getting this wider spread. And what it does is it impacts the liquidity that's out there. So we're seeing a less liquid situation. I put up an article that talked about car loans and car sales. Car sales are plunging right now. Why? Because they're not making the loans to the higher risk people anymore. That's a big deal. So if all of a sudden you see 10% fewer cars, and I think last month it was 7.6%, if you see less cars being sold, that's a huge component in the American economy, right? It's not just GM that will have lower profits and make less money. It's all the companies that source to GM. And there's thousands of them that make parts. So you need to be aware of that. So Raul Paul talked about this, and what he said is, you know, the OIS spreads over LIBOR have been leading the dollar by about 3 months for a while now. And they actually, historically, it's 6 months to a year. So somewhere between 3 months and a year from now, the dollar should surge. That doesn't mean it won't get weaker in the meantime, and I believe it will until there's a catalyst to start pushing the dollar up, which could be a conflict in the Middle East, or it could just be that eventually liquidity tightens up to the point where it happens. So eventually the dollar gets stronger. I'm going to say about a year from now, and it could be earlier, could be a little later, who knows. But LIBOR is indicating that it will happen. It's really bad for certain institutions. Deutsche Bank, this is just, you know, wreaks havoc on them. They've been walking a tightrope for years, and who knows when that's going to go wrong. So here's the 3-month LIBOR based with the dollar chart, and you can see that the dollar goes up. If LIBOR comes down, then the dollar comes down. LIBOR goes up. Eventually, the dollar goes up. And this is how I made this call right in here. I knew that none of this made sense. So I knew the dollar would start going up. But now that LIBOR is going back up because inverse relationship, it's difficult to see the dollar getting much weaker, maybe 10, 20% short term, because people focus on the debt situation here in the United States. But you got to remember, Europe is in worse shape. Japan, they have all kinds of problems that eventually it's going to lead to a collapse. But they've done a great job avoiding it. And actually, maybe there's a lesson in that for us. And then China, as their economy slows, as their population gets older, as they have to take federal money to bail out the municipalities, eventually there's a crossover there too. But where is that? It's years into the future probably. So I don't think there's any imminent destructive thing on the horizon, but that does all go back to valuations within the market, which I talked about at the very beginning, as valuations are high. And that is actually in the Gary Cohen article. I believe I show a chart on valuations. So you've seen this chart before, where I think the support levels are. And I don't have the valuation chart in here, but it's not hard to find. Oh, you know what? I put it into the best advice article. I wrote an article from millennials yesterday that I didn't think would be popular, and it's flying. But here is a valuation chart, 4 different methods of valuing the market, and this is arithmetic. There's a geometric way that makes it look worse, but let's say the things aren't that bad. Tech bubble, housing bubble, where we are now, right? Some people are calling it the everything bubble. Like I said, all the money printing, which is really printing money that's borrowed, right? So eventually you have to deal with the dead end of that equation, is pushing prices up. I don't think we ever really get back to the mean, but we might. We might see it. I think that something like the tech bubble crash is more likely, where a couple of asset classes get whomped and everything else comes down, but not as bad. So, again, 1,600 on the S&P 500. I keep looking at it. It keeps making a lot of sense to me. 2,200 would be that first step down probably. So again, LIBOR is signaling a dollar rally in the next year or so. Valuations are high, and we have to be careful with that. So really, I think that we've moved to Shiller's right here. Cyclical PE, that's Shiller. That's basically Shiller. And it's a good one, but it doesn't tell you how to time the market to today, because, we're here now. And I'm just answering a question on the chat room. So here's Shiller now. That's how high it got. So we're equivalent to where we were in 1929, basically. And by this measure, we're higher. And Cressmont, they're talking their book a little bit, because they've been saying that this is still a secular bear market. I'm not so sure. I don't know what we're in. But, we're getting close to the point where valuations matter. And that's ultimately the takeaway here. Ultimately, valuations matter, and there will be some trigger to cause a reversion to mean. A strong dollar event could be that trigger. The video talked a little bit about Japan. I've been paying a lot of attention to Japan for years. I generally stay away from it. I trade it here and there. I don't really talk about those trades because they have to be pretty precise, and I think that is something that either you know how to do or you don't. But we have the couple of ETFs, the iShares Japan, the Wisdom Tree Japan hedged, and the hedged has to do with the dollar. I think that there's an opportunity for this hedged one, short term maybe, but really, if the yen surges in the short term, the hedged one is down the road. If the yen surges, then Japan market should surge. So we'll see how that goes. I'm not so sure I believe in the safe haven arguments for Japan, but it happens. It shouldn't, but it does. Those are the hardest things to invest in, things that happen, but you don't understand why, or that shouldn't, and you're pretty sure that they shouldn't. Here's the dollar and the spot crude price. As you can see, there's a pretty good correlation. When the dollar goes down, the price of oil goes up, and that clearly was a big deal here. But look, the dollar went up here, and oil still went up. And I think that that's what we have coming. I think that this period is what we're going to see. We're going to see the dollar go up starting at about 3 months, 6 months, a year, whatever it ends up being, and the dollar is going to go up too. So we're going to get a situation where both the dollar and oil go up, and that's realistic. It happens. So we need to not think that just because automatically the dollar goes down, oil goes up, and vice versa. Sometimes they move together, just like the dollar and gold did for a while. And the reason is that the two markets do have different underlying fundamentals. Oil is ultimately a product of supply and demand for oil. The dollar is a product of supply and demand for the dollar. Now, as the world uses fewer dollars for oil, that relationship will really amplify down the road. However, we're not there yet. Even though, and I haven't even checked, China supposedly is going to start trading an oil futures contract later this month. And it may have been delayed already. I don't know if anybody knows offhand. We're not likely to see the dollar get crushed because of it. And you really should throw out of your mind any ideas that the dollar will ever get crushed, because relative to the other major economies, the currencies in the IMF special drawing rights basket, we're still the cleanest dirty shirt. Dirty shirt, sure. But we have more spots of the clean spots than anybody else. So that's important to know. And finally, the dollar index to the S&P 500. See, dollar is basically range bound, right? But the S&P 500, bam. And so you know that right about here is where I think the new bottom is, 1600-ish. I don't think we'll get below these peaks ever again. There's just been too much money added to the system. All right, questions and answers. Beyond central bank money, how much has corporate borrowing played into buybacks? A lot. And how does corporate leverage look as a partial consequence? So the corporations have a lot of cash on their balance sheet right now because of the repatriation and tax cuts. And what I argued here, and I didn't go into the debt, I'm saving that for another article because I'm going to hammer different companies. But what I talked about here is that, somewhere in here, I talk about how companies, a lot of companies in this list, ought to be paying off their debt, right? They'd be better off paying down their debt, right? And modernizing their companies, right? Adjusting to the markets. And a lot of these companies aren't. And this is not a new song and dance. We have seen this happen before the financial crisis. We saw this happen. Explain to me why corporate buybacks, explain this to me. Explain to me why corporate buybacks surged in 2005, 6, 7, 8 when the stock market was getting more and more overvalued. The answer is that a lot of these boards of directors and executives, and I'm sorry that if it's not part of your makeup to believe this, but enough of these guys are in it for themselves, and they know that their bonuses are tied to share price appreciation more than anything else, that they push the share price up by taking corporate money and buying back shares to drive the share price higher short term. That gets them usually a higher salary because they say, look how good I'm doing, and they get a gigantic bonus because they have all those stock options that they can now convert at these prices. And then it crashes, and the guy from this company goes to that company, and the guy from that company goes to that company, and they all switch, they all shuffle chairs. This year, the buyback setting a record near $1 trillion is the same damn thing. They should be paying off hundreds of billions of dollars of debt because we know, as we just talked about with LIBOR, we are moving, and we know the interest rates are going up. We're moving into a less liquid situation because we have to control the debt somehow. And these guys are just making the same mistake again. I don't know how much more clearly I can make that. I'll write an article about it, and I'll just hammer a few of them to make the point. Any other questions, or are we really going to get done in under an hour? All right. So we want to move into questions about specific companies. So I'm going to turn off the recording.